Good evening, everyone, and welcome to iFAST Advisor Insight. I'm Dipali Lalwani, and today we'll be talking about benchmarking and strategies in retirement planning. When I was researching for this topic, someone explained to me that creating a retirement plan is essentially about building on top of a few important benchmark numbers, a few important assumptions, and a few classic thumb rules of financial planning that we use. Well, the world around us has changed a lot in the last 5 to 10 years. And it's not just because of COVID, right? Our lives, our careers look very different today. And the markets have changed in some very significant ways too. Now, how has all of this affected the strategies, assumptions, or benchmarks that we use when creating a retirement plan for our clients? This is the question I'll be asking our panelists today. Before I bring them on screen, one small announcement. We will be trying to take audience questions, time permitting. So if you have questions, please add them into the YouTube chat box to the left of me. All right. I'd like to first call on screen Trupti Murlidhar. Trupti is an individual registered investment advisor who started her financial services career in 1992, the heydays of the Indian capital market. With 2 decades of experience advising clients, Trupti believes in adopting a strong multi product approach. Welcome, Trupti. Glad to have you on board today.
Thanks for the introduction.
Our next panelist today is Saurabh Mittal, the founding director of Circle Wealth Advisory Private Limited. Saurabh is an investment advisor, investment management expert with again 2 decades of experience advising clients. Saurabh is also a very well-known figure on social media, television, and radio, so someone with a strong media presence. Saurabh, pleasure to have you here with us today.
Thank you so much. Thank you.
Our product planning expert today is Shelly Gang, who's the head of products with Tata AMC. Shelly has over 15 years of experience planning and developing products in the mutual funds and alternative space. Welcome, Shelly. So glad you could join us.
Thanks so much. Thank you, Dipali. Glad to be here.
Great. Thank you. Thank you. Now, to start off, let's look first at the context of retirement planning in India today. Now, formal figures are, of course, difficult to come by, but I did see two studies released recently. One was in 2018 that found that two-thirds or 67% Indians are not planning for their retirement. Now, they may be aware of retirement, of the need to plan for retirement, but they're not prioritizing or actioning it. The more recent study published in October 2020 found that 51% of Indians are not planning for retirement. So is this an improvement? Starting with you, Trupti, what is your experience? Is there really an increase in the demand for retirement planning?
I wish to say hi to all my advisor friends who are watching me today, an opportunity that I rarely get to do. Thanks, Dipali, again for the introduction. Yes, actually, if I say it in blunt words, yes, we in the last 4 to 5 years, we advisors have seen a lot of demand for financial planning through new clients. I will refer to the retirement survey which PGIM has done, which is quite exhaustive. Some of the points which they have pointed out answers this question very well. The conventional model of stable income and retirement by 60 is actually getting outdated. Hence, the awareness of financial planning requirement has surely awakened among Indians. We are seeing that awakening among Indians for financial planning. Demand for the financial planning is focused more on the happy outcomes rather than these eventualities like retirement, though. But elements like, breakup of joint families, presence or absence of alternate source of income, fear of dependence on children is in old age has changed attitude of people towards retirement. Most Indians still don't have a retirement fund as they haven't begun their planning as yet. they do have all-purpose funds and investments that they may later be used for retirement in case of, worst case scenario, it is not being used. But proper retirement planning is not what many are yet planning.
Okay. That's that's quite interesting. Saurabh, what's your experience like?
So I would say that the number is encouraging, but as you say that statistics reveal only so much you want to hear. I think obviously there is a lot of awareness about people really understanding the importance of retirement planning, but also there is so much of misinformation about what really is retirement planning. To some people, it's just investing in their PPF is retirement planning. To some people, it's just investing in NPS is retirement planning. For some people, just buying another property may be retirement planning. So retirement planning awareness obviously is existing and increasing, like Trupti said, because of various reasons, nuclear families and dependency, and people want to be independent, but you really don't know whether they're doing it in real true sense or not. So obviously the awareness is there. We are moving in the right direction. I'm not sure how the pace is that high that it is reduced from 61% to 51%. But yeah, I mean, obviously we're going in the right direction, but not sure as to are we really encompassing all the needs that one would need to have a successful retirement being planned.
Thank you, Saurabh. So it is obviously a very layered subject and not very easily categorized that way. Okay, Shelly, coming to you as a product planner, are there any macro trends that you track, to understand the retirement planning market as a whole or shifts in needs of the retirement planning target audience? Is there something that you can share with us about that?
Sure, Trupti. Of course, I would want to bring here the lay of the land. We were discussing this the other day, and I'll bring in some points, from the discussion, which post a discussion which I could put together. I'll just, it's of course there are multiple points, but I will navigate through them, quickly and stressing on the points which are important. So, just relating to the previous point, which Tripti and Saurabh both answered. See, what's happened is, retirement as a practice, or retirement planning as a practice, is not very old, and the proof of the pudding is in the fact that even the 401k account, which is the US account, that came into existence, or that was created only in 1978, which is not too far. So in India, the NPS and EPFO and EPFO getting deeper into equity investments, and that those developments have recently happened. But even in the developed markets like US also, the creation of 401k was only 1978, which is surprising. It is too soon back. Then it's not too far away, or it did not happen a long time ago. That's the point I would bring in here. Just to bring into perspective the macro changes. So what has happened over the last few years, and the data points would change as the number changes. So inflation, repo rate, and 10-year GSEC, that has come down over a period in time. Along with that, the real interest rates are negative for most countries currently. It's only Indonesia, China, Russia, to some extent, Turkey. Those are the countries, very few handful countries, who have actually positive, real rates of return. That's the other part, tagging along when we say the inflation and repo rates have come down, or interest rates overall have come down, in the world. The other thing which has happened is the Nifty 50 PE, which is the price to equity. Those valuations have trended higher. So in 2001, they were at 14. In 2005, the average, the PE moved to 15.5. It has remained above 20 since 2015, and in 2020, of course, the exception was there because of COVID, so it went down. But otherwise, it has trended higher. Now, current high valuations are one reason is you can what you say, you can attribute that reason, attribute that event of current high valuations to huge liquidity is one. Low interest rates, because you use a matrix or you use an interest rate to discount the cash flows and come arrive at the current valuations. So if the interest rates are low, the current valuations of course are elevated because you are using a smaller number to discount the cash flows.
Hmm.
Also, in the same breath, I would like to highlight, and this is from the Flame University presentation, which was presented by Mr. Manish Chokhani, and he made a very, very valid point that the valuations are currently higher because of huge liquidity and lower interest rates, but the future valuations, and because we have so much of disruption, and disruption in a very, very positive manner, I'm saying, if you hear Kathy Woods of ARK Investment, or if you hear Mr. Manish Chokhani, even in this presentation, in India as well as in the world, the kind of disruption which is happening across industries,
Hmm.
whether you say you take any industry, so that is causing a little, markets are taking time to recognize the certainty of earnings which are there, and that is why the future valuations right now are undergoing a little bit of uh, um, volatility or uncertainty till the time we actually get hold of what kind of earnings and growth will come out of those disruptions after they have played out a little bit. The only thing which I would want to point out here is that earlier disruptions like electricity and any other old age, any disruption have taken a longer time, like 45, 50, 60 years to have played out. But the current set of disruptions will take 20, 25 years or maybe 15 years to play out. So that's a very good thing. It's a fast track growth, a front-ended growth from the next 20 years perspective or 15 years perspective. That's the third point, which I will just keep it tight and hold it there. The other part which has occurred because of the first 3 points is the return expectations of both equity and debt have got reset. And that's a very important thing when you go and talk to an investor. For him, you're no longer getting 8 and 10% in equities, in debt, and you are no longer getting probably 12 to 15% expectation, or at least we've not seen that in the past 5 years. So those return expectations have got reset. Retirement age is coming down, at least for the private sector, and the mortality rate is getting better. So what you're facing is with the returns getting reset a little bit to the lower end, your risk of living too long going up because your mortality rate has improved and your retirement is getting early. So you have to spend a larger amount of your life, with depending on your investments. That's actually the conclusion out of this. And the last part to this change, the macro, is that while incomes are not going up, but you have a very good financial and savings and wealth which has gone up. So that effect, the wealth effect, and your increase in savings, because the return on the savings have been higher because the markets have done well. So incomes probably have not gone up or not going up, but the wealth effect and financial effect is very good. People have that wealth, and that's causing a very good impact on consumer spending on the discretionary segment. So overall, I thought I'll pack it in from market history and what are the trends, and what's happening. And maybe as we go ahead, we'll talk about the policy changes also.
Sure, sure. Those are some very good insights, Shelly. Thank you so much for sharing. Trupti, coming to you, some of the things that Shelly spoke about as well in terms of, the age going up or the retirement age coming down. How does this reflect when clients come to you in terms of what they say they want the outcomes to be from their retirement planning? Right? You also mentioned that the focus tends to be more on the happy outcomes. Can you share a few case studies with us, please?
As Shelley rightly pointed out, the de-accumulation stage is actually increasing, and the accumulation stage has shortened. This makes it very detrimental, especially for the younger generation, which is the millennials and the Gen Z population, which is for them, it is very detrimental because they have to plan. They have a very short time to plan for a longer duration of retirement period. Now, when you're talking about, experience for the retirees, the major change is that the Indian small savings rates have come down. Fixed deposit, which used to be their solace, does not even provide inflation-based return. And finally, there are these clients who have been saving for a longer period of time, who have taken call on real estate, banking on real estate to give them regular income over longer period of time, are also facing challenges in terms of regular income. For those who are approaching retirement, who are there in the final accumulation stage itself, we as advisors tell them from day one to have debt products. The accumulation of these debt products should be into these small savings and kind of investments like EPF, PPF, small senior citizens saving schemes. These kind of investments should be done in the initial accumulation stages, so that the far end of the accumulation stage, it is much easier to handle the movement of asset allocation towards debt. That makes it much easier for the life stage of investors to be planned properly. The idea finally is to manage the stages of retirement, but that also there, see, finally, whether it is an accumulation stage or a de-accumulation stage, asset allocation is very important.
Right.
As and when we approach the retirement stage, most of the investments have to go into debt, whether it is 70 to 80%. It has to be planned accordingly. Individual cases, it is always different. Planning for retirement for individual cases have been completely different. There are HNIs who have huge amount of funds. There the planning is totally different. When it comes to certain other retirees, like a government employee who has been planning for a very long time, like 30-40 years, for him the planning is totally different.
Fair enough, Trupti. Thank you. Sort of building on top of what Shelly and Trupti shared as well, see, one of the key concerns around retirement planning today is the low debt yields, right? So how do you think this is affecting the classic asset allocation, the 100 minus age being the equity allocation thumb rule? So does that still apply? And how are you looking at the growing risk that needs to now be taken on in a retirement planning portfolio?
I think, couple of things here. One, thumb rules obviously don't work for everyone. Thumb rules are generic idea for people to just estimate whether they are way off of the thumb rule or not. And so obviously it is not something which will help everyone. One very, very important thing, like Shelly mentioned, is that retirement planning is a very, very recent phenomena. And all of us are in the same boat where, we are practicing as planners since 15-20 years, and we've seen various goals matured for our clients. So, where clients have planned for their children's education, and now we're actually seeing the fruits bearing, and they are able to redeem their investments and send their children for rightful education. And it's a pleasure. But none of us have actually seen people who have kind of completed their accumulation stage, started using the money in the de-accumulation stage, and have lived through this life and seen that those assumptions that were made have actually played out. So like Trupti mentioned that, at certain point in time, 5-10 years, 15 years back, real estate was something which everyone wanted to invest. And today they are stuck. And that is my biggest fear. What are the assumptions are we going to take? How those assumptions are really going to be, valid for next 20-30 years, even for people who are just retiring and they're going to sustain, like rightly said, that the mortality are going up. So you might need to plan for 25, 30, 35 years for people to sustain on that corpus that they've accumulated before retirement. And so this resetting is going to happen over these 30 years, right? So like the expectations, all the returns expectations are coming down. Inflations have come down significantly from where they were about 10 years back. But then how do we really predict what's going to happen in next 20, 25, 30 years? How do we really take the net of inflation return on these various asset classes? I think to me, that is the biggest challenge. And so for me, the crux of investment retirement planning is not really getting into, what is the asset allocation. To answer your question, is not about what products are available or what is the risk that investor can take today, but really to estimate as to what that inflation is going to be, and what is the net of return that an investor needs to generate. Also, there's this a huge need that an investor has, is that he doesn't want his corpus to go down initially. He just wants to live on the appreciation that he would face, whether it is in terms of interest or in forms of dividend that he might get on other equity investment, which again is a very, very challenging thing, because there is no plan as to how that money is going to be utilized at mortality, and b, the kind of need which it increases. For example, a classic pension plan today, even if that person is able to live off the pension 10 years down the line, the amount of pension is going to remain the same, but inflation is going to force the expenses to at least double up at 7% rate. So how will the person then be left in that position where he doesn't have any kind of liquidity, because all the money is locked into a pension fund, and the liquidity is only half of what is actually required for that. So I think to crack the right asset allocation, convince the customer to give away the the innate need or want of preserving the capital are something that every one of us have to work on. I think we're on the same boat, and there is no experimenting to it. But lower, the more realistic or pessimist we are, that things can go way away from what we are estimating, I think will help us in treading the waters.
That's so interesting what you said, right? I mean, I've always heard it said that a big part of an advisor's job is expectation management.
Correct.
So yeah, like you said. Saurabh, I did have a follow-up question to this. Now, we've been talking about global investing, and Shelley shared some facts as well. Now, developed economies have been living with low debt yields and, like she said, negative real returns for years now. So, are asset allocation strategies from there relevant for us at all, or do you think India is not really headed in that direction?
No, so obviously we are also seeing that the interest rates are going down in India for short term, while real interest rates were positive at certain point in times. But I think just following blindly what has happened in the West might not do the job for us. A, because the kind of structure that they have, where they have low inflation as well, and B, also because they have certain kind of social securities available to them. We don't have that privilege, right? So we have to be completely dependent only on the assets that we have built. So obviously the interest rates might go down. The person might have to take much more risk than what he is expected to take as per the classic expectation that we were building for our investors. But I think investor cannot just just follow the West and say that because interest is going down, let me increase my equity allocation or get into risky products. But yeah, ultimately what's going to happen is to kind of evolve ourselves and keep on making our asset allocation right, which we feel will help us in lasting it as long as possible, at least till the mortality age.
Okay. Thank you, Saurabh, for sharing that. Shelley, coming to you, the focus, as you can see, is largely on the consumption or the de-accumulation phase. That is where the challenge seems to lie. Now, coming back to, some of the macros that you shared or some of the benchmark numbers. Now, in terms of pure number planning, can you share a little bit about what are the numbers you're working with currently? When you look at an annuitization, creating an annuitization for the corpus.
So, Trupti, the way to, look at this is, see, many people are not, they don't even have a simple, simple count of the few of the numbers, and that's where we need to start. Of course, current age is no rocket science. Age of retirement, you could put 55, 60, depending on what the client, or investor is looking at, what plans he has. Many people have very varied plans. We hear they are exhausted early in life. They have other plans, so they want to retire early. You can put accordingly life expectancy. Maybe it's good to put 80, 85 because that's the case right now. I've just taken a very bare, an average expense of like 50,000 rupees because that's the monthly expense. One important part is that the EMIs should be excluded from the monthly expenses here. That's very important, because the assumption is that you won't have those EMIs when you're retiring at the age of, let's say, 65 or 60. So that definitely should be taken care of. Inflation rate has been taken at the rate of no, this has been taken at the rate of 5%. It's a typo. Just give me a moment. Okay, we'll work with this 5%, because that's where I had keyed in on the Excel. The So 4% anyways, plus 2 plus minus 2% is the range which even RBI has defined. So we'll work with 5%. Expected return pre-retirement and post-retirement we've taken at 8%. The logic here is that usually the way it comes out is your nominal GDP is about 11-12%, and plus 2 to 3% is, or 2 to 3% is the market return. And so let's assume that if the nominal GDP right now is, let's say, at, on a very conservative basis, 10%, your the market growth would be about 12-13%, and inflation is at about let's say 5%. So from that perspective, what I've done is 11 plus let's say 2%, which is the market growth. Like the data is in the last 15 years, or the last 40 years, let's say, the Sensex has grown the GDP has grown by 13% CAGR, and the Sensex has grown by about 16% CAGR. So that's a longer period, 3% more. But we can work with, let's say, 2% more. So 11% plus 2%, 13%. But on an average, because all your monies won't be in equity, and that is why we've taken a 8% return, a conservative return on investment. Then one should obviously have the current savings and investments. I've just taken a sample of let's say at age 35, somebody already has a savings and investment of 10 lakh. And it's important to key in a number here, but right, for simplicity's sake, I have just kept it blank. But you should be putting what is the current PF savings and what is the monthly contribution to PF happening. Because even this amount, this 10 lakh amount, will grow over the next few years till you reach retirement. And even the monthly contribution to PF will also grow. So, that also needs to be accounted for. So once we have this data, we know that we know at current age, when are we retiring? So how many years to retirement? What is our life expectancy? Which means 20 years is the period, 85 minus 65, during which there will be no income coming in, and and there'll be expenses, of course. And the corpus has to be enough at age 65 so that your current lifestyle, current monthly expense, adjusted for inflation, at age 65 can actually serve you very, very well. So if you put it in this calculator, let's say, in an Excel, you will get the amounts which are there in the below grid. So important to know the current monthly expense, important to know what is your current stock of savings and investments, important, of course, to keep track or key in an Excel what is the monthly contribution and what are your PF savings, and once you have this, you would know that what are your monthly expenses per month at age 65, because right now it's 50,000 rupees. Once you add the inflation rate and your expenses growth rate also, maybe the expenses are also growing, will grow at a particular rate. So added or adjusted for both, growth rate of expenses and inflation both, what is the monthly expense which you will actually incur at age 65, which is close to 2 lakh rupees, let's say. Now, if you were to incur 2 lakh rupees, what is the corpus that is needed at age 65 to maintain the expenses post-retirement at age 65? And that's the corpus which comes out, when you apply the real rate of return to that. Because you have an inflation rate which is at 5% and you have a expected return. So you also apply a real rate of return and then you arrive at a corpus of 4 crores. Meanwhile, your current savings of 10 lakhs have also grown in the next 30 years, because 35 to 65, that has also grown. And that gives you, just move this bar, and that gives you, let's say, a figure of 1 crore. So net, what is the corpus you need for at the age of 65? And if you need this corpus what is the monthly investment or what is the lump sum investment which you need to make every year starting now. This amount, what happens is most of the people, uh, are can be non-starters because there is no flow and structure to arrive at this amount. Once you're convinced that there is a structure you have applied to arrive that is at this amount, I am sure the execution will also happen. This it is given up midway because it is not structured. If it is structured in this manner, then definitely an amount will come out, and then execution of this amount in terms of investment will happen. So I don't know why this is hung. Yeah, sorry. Yes, so that's that's where the numbers which you were talking are there. And then how do we apply product planning for a person? Maybe we'll keep it for another for another phase of this session.
Great, great. So, for me, the most important numbers, of course, were the logic that you explained for the expected percentage rate, right? Pre-retirement and post-retirement, and the logic that you were using to calculate that return. Those were pretty important. And also the fact that, the monthly expense, you need to adjust that for growth as well as inflation. So, some good insights there, Shelly. Thanks for sharing. Saurabh, coming to you now, in one of your previous responses right now, you said that advisors may very well see successful accumulation phases, but it's the consumption phase that proves elusive. And although you did say that it's a little difficult to really, because it is ultimately about predicting a specific client's future. So, can definitely see the challenge there. But I'm still going to press you and ask you if there are any models or anything that you use that can help advisors to improve their outcomes, to test the strategies that they use.
So, I would just say that, what Sherry presented, I think it's absolute. I mean, that is what we've been doing and giving the client that what the requirement has been. I think what I was saying as a challenge is that, this margin of making 3% more than the inflation, is it really going to be possible for us? Is it really going to, I think we should start challenging ourselves, right? Because the assumption is from age 35 to age 85, right? So next 50 years is what we really need to be sure about, that this will eventually work out. And obviously, it's not something which is written on stone. We'll need to evolve. But just going by what Shelly gave it, just an example, I'm just trying to interpret as to what we try and understand and tell our clients. So if we return at 8% and we are assuming a return of equity on about 13% and inflation of 5%, and I assume that there is a zero real return and there's no negative real return, and that is also able to give us 5% net of taxes. Even if we assume that, that means that we have to have at least 40% allocation to equity. So 40% equity allocation will give you around 5.2%, and 60% allocation to debt will give you 3%, which will give you a return of about 8.2%. So we have to, what is more important is to tell our customer that even till his mortality, probably, he would have to have an allocation where the corpus is 40% allocated to equity. And obviously, it is not that initially the client starts with 40% allocation, he have a much higher amount and it will be tapered off. But still, you need to have that kind of, visibility that the client is okay, that he is invested into equity. What we are trying to do is that we are kind of challenging ourselves and saying that, what if the customer wants to put all of his money, all his retirement corpus in equity? What happens does, and that what we're trying to do is we are trying to backtest the data from 79, because that's the oldest data that we have available in India. And if customer is withdrawing of X percentage of amount every month for 25 years or 30 years, what is the amount that he can withdraw on an average? What is the minimum amount that was available in the past? What is the maximum available in the past? And obviously, what is the average? Which might give us some kind of, estimate as to, what would be the volatility. And still, by investing 100% of his money in the equity, what are the chances that he beats inflation and he is able to survive the whole de-accumulation stage? Obviously, it's a very complex sheet. We've been working on it. The inspiration comes from Nick Murray's, kind of comment that he said that you can have an STP from an equity might be more SWP. Sorry, a withdrawal from equity might be more rewarding than a classic debt equity combination or a pure debt combination. So we are working on it. So far, from what we have seen, someone who's invested in the worst phase, where he invested at 92's peak in Sensex and redeemed his money in 2007-8 for a 25-year, the minimum withdrawal that he can still do is 3.3% of the corpus on a per annum basis. So it kind of gives you a ballpark figure that he can sustain for those, he was able to sustain even entering at the worst phase. But the average, what it seems is that if a person is withdrawing that amount, he is still left with a higher amount, inflation adjusted, than the capital he invested. So if I start with, say, for example, 1 crore, on an average, if I withdraw, say, 4% per annum, at the end of 25 years, inflation adjusted, I will still be left with more than a crore on an average, but the minimum being 3.5%. So we are working on those sheet. Let's see how it works out. So it will
Great. Yeah. This seems like a very, very interesting experiment, and I have a feeling we're going to get a lot of calls, Saurabh, after this. Okay. Trupti, coming to you now. We've discussed about how, as advisors and as planners, you all can look at asset allocation. I want to now talk about client expectations, right? What are the objectives that you try to balance for your clients when you're creating a strategy for the consumption or the de-accumulation phase? So, for example, be it tax, sort of tax outcomes or liquidity. What are the different objectives you need to balance?
So basically, it's a fantastic this thing which Saurav has already provided in terms of how one can actually look at a long-term data and try to give SWP, which is one of the things which every advisor would like to do, because considering the fact that dividends are taxed and net income what comes in the client's investors' hand is much lower today compared to in the past, where equity incomes used to be capital gains or dividends used to be tax free. But I still stick to my distinct decision about doing things as per asset allocation. Asset allocation during accumulation stage is a totally different thing, but asset allocation during your consumption phase is where we look at providing for 2 to 3 years of living expenses which are purely parked into liquid funds. No, the focus is not on making returns, but purely making little better than what a savings could do. Then you have this 3 to 5 year funds where we look at high quality debt products. Yes, I know the returns on debt is going down, but that is what basically when you look at a longer period of time, we would always look at a high quality, any kind of debt product where safety will be of highest priority. And from 6 to 15 years, we would look at, probably at duration funds. But year two now, you can't compromise on risk when you are on a consumption stage. 15 years plus corpus should be invested more so into hybrid and equity. But the proportion of hybrid equity also has to form part of retirement corpus, which not many are ready to accept. So this is the kind of allocation I would want to give. And yes, have a little more exposure to equity and do SWP for, later stage in the consumption phase, where you can, tend to grow even during retirement phase, you grow the equity portion of the corpus and start doing an SWP. Further to that, other than these asset allocation, obviously we look at smaller aspects like nomination should be there in clients' folios. Those are very important things. Only I don't think distributors would look at all those things, but we look into those smaller things where nomination should be there. In addition to nomination, we encourage clients and actually force them to do will, so that the transmission process for the heirs are much easier. They don't take too much time to do all these processes, which is tedious in a way. So these are the other smaller things which need to be looked at when you are looking at the consumption phase of the investor's life.
Great. Yeah. These are all pretty important. Coming back to you, Saurabh, you also commented on, the slight push and pull that tends to happen, between when the corpus needs to be locked in versus clients needing liquidity, or clients being worried about their corpus not being depleted, even though, that may be a requirement based on certain circumstances. So how do you handle this trade-off?
So it's a classic thing. I mean, there is so much insecurity that people have about not losing the corpus of the valuation going down, that when they are ready to forgive any kind of cash flow that might be arising. And people, like I said, all of us have not experienced the perils of not having proper retirement planning, because what has happened in the earlier generation has happened and they've survived and not sure, what's going to happen next. So I think there's always been tussle. We've been trying to always showcase the importance of liquidity, like I mentioned about this pension plan. And I think, as you highlight these things to the customer, that is not only about what you start withdrawing today, it's always that you need to think about what's going to happen after next 15, 20 years. Your medical expenses are going to go up. Like Shadi was mentioning, it is not only about the expenses that you are already incurring, but there's going to be multiple other expenses that might get add on. So you might have to recruit a house help, which probably, because you are physically more fit at retirement, you don't need, but at the later stage of life, you might need a house help. You might have increase in medical expenses. I think so. The flexibility and liquidity is something which needs to be given much more importance, and not locking in the money in pension plans or something like a real estate where there is no option for liquidity. I think it needs to be highlighted. Just one more thing, and in my previous discussion, I was telling about my study. So a lot of people might think that 4% is what a pension plan is also giving. And since we were just asking why would someone want to invest in equity, so when I said 4% is inflation adjusted. So whatever is the corpus, whatever is the expense which is required, will keep on going up at the rate of inflation. So it's not just that 4% remains constant, and that is what we want to really bring into the customer, that ultimately he should be able to survive the anomalies of inflation and ultimately get the inflation adjusted return and the expenses that he's going to finally have in the final years of life.
Right. Great. Shelly, coming to you, both Trupti and Saurabh have clearly highlighted, the need to balance these requirements for, people in the consumption phase. In terms of your product planning, how is it that you are factoring in all of these objectives?
So what we do is, these are the things from the product perspective that we try to do. One, of course, is as a house. We want to be a full service house, as an AMC, and any AMC would want to do that. But, I would right now talk about our thought process. So one is we would want to have a balanced offering. We would want to have a spread of active and passive, passive funds, because the growth of passive has been phenomenal right now. I think there was a chart on growth of passives, but I think it doesn't allow me to move, but I'll stick to this slide for now. So the growth of passive in the last 3-4 years, has been humongous. Of course, some of it is government-led also. EPFO has been allowed to invest up to 15% into equities, and monies are flowing into ETFs as well. So as a house, we would want to have a good mix of active and passive style of investing. In terms of growth, value, and gap mix, we would have to have funds across. We would want to have funds which are top down, bottom up approach, which are right now there, where the decision is basically more oriented towards picking up stocks, and then the sector allocation is incidental. But the other fund, like our recent launch on business, business cycle funds, also focuses on top-down approach, keeping the macro in mind, macro superseding everything, and then we navigating across sectors depending on whether how the macro is, and we want to be on the defensive, side of sectors, defensive sectors or cyclicals. So that's important to have. We would obviously offer income-oriented funds, absolute return funds, alpha generation funds, of course, alpha generation funds, and bottom-up funds. You could actually use alternatively or interchangeably rather. And then in our portfolios, equity portfolios specifically, we would want to have a good mix of defensives and cyclicals. We are also mindful of the fact that now convergences among country economies are there, and overseas exposure is very, very important. So how can we introduce that in our existing funds or introduce new funds accordingly? So that's on the balanced offering from the product side. What we also keep in mind is, so that the accumulation phase can be efficient, we want to enable STP, SIP, and into our equity and debt mutual funds, and for smaller amounts as well, so that because the incomes come to you regularly, and of course in parts, it doesn't come to you in bulk. So if incomes come in parts, you have to have features which can capture those part incomes, and SIPs are a very, very good way to do that, and debt SIPs specifically. Debt SIPs have become popular also because of the fact that now the latest tax ruling does not allow you to invest in the PF, or the investment into which goes into PF beyond 2.5 lakhs is also taxable. Earlier, a lot of money would sit there, uh, you know, because it was not taxable and it was a good rate of return. Though it was locked in, but it was earning a very good rate of return. But now a lot of that money beyond 2.5 lakhs, which goes in, which gets taxable, people would take a call that not to expose so much into the locked in thing of PF, Provident Fund, and rather introduce debt SIPs into their portfolios, to the same amount. So debt SIP could become very, very popular and are being inquired more on account of that. We've seen what you call unique events like COVID, and earlier also we've seen back-to-back market events in India and globally, and that actually has brought a higher proportion of cash, into the portfolio. And when I say cash, I don't just mean emergency funds. I mean up to 1 year, of holding period funds, and that amount, that percentage has actually increased from 10-15% to about 25 to 30%. 30% is higher, yes, I agree, but what this enables to do people is not disturb their core portfolio by running around in case of such unique events. They don't have to disturb their core portfolio, and they can navigate through that phase easily with this cash portfolio. Otherwise you make unmindful redemptions and actually hurt your portfolio in the long run. So we offer products on the cash side as well, and we are mindful of the holding period, and this is how we have our stack up. Less than 1 month, of course, overnight funds are there. 1 to 3 months we have liquid funds. 3 months to a year we have money market and arbitrage funds. Arbitrage fund, arbitrage as a category has seen a lot of inflows. 1 to 3 year there are short-term bond funds, and more than 3 years you have equity funds, asset allocation funds, hybrid mutual funds, and debt accrual funds. So this is the complete stack. So the first stack is in terms of style. The other stack is we also look at the stack from the holding period lens, so that we can offer a full service. And then you have asset allocation products for clients who do not want to, one is they don't have the courage to actually shell out money for equities when there is a deep cut and valuations are very attractive. But do clients have the money to have the courage to shell out money to invest into equities when you've already seen like a 20% cut? And every 10 years you will see cuts, because that's how the markets function. So every 10 years you will see deep cuts. Your portfolio needs to be prepared for that. So some kind of asset allocation product needs to be there, so that moving from equity to debt and debt to equity becomes seamless for the client, as they navigate through the phases. And it also becomes tax efficient, because you were to redeem from debt and put it into equity, or redeem from equity and put it into debt, your folio obviously undergoes tax application. But when you do it under a tax allocation product, you are taxed only when you redeem the redeem the folio of the dynamic asset allocation product finally. So that's a very,
Okay.
very important part. Even commodities have been introduced under multi-asset fund. That's the third asset class to look at when you look at asset allocation, and same tax benefit applies. If you don't redeem your folio for 5 years, 7 years, you can have this adjustment without any tax implication to you. And the glide path is very important. So right now you will hear about a lot of DIY products, or there are platforms being spoken about where there is an auto glide path available to a client as per the age. The very thumb rule is 100 minus your age
Yeah.
is what you should have into equities, I'm sure everybody. But how do you execute that on an auto basis? And you have a plan on paper, but you can actually put that plan on an auto mode, and actually take exposure to such products which will give you this kind of a glide path. That's very important. So, and then SWP, yes, was spoken about, I think, by both Trupti and Saurabh. But yes, SWP is a very good and tax efficient product for liquidity creation. So the way it can be visualized is, in the accumulation phase, you use SIP and in between bulk investments. Don't just sit out of the market. Do that. Create a corpus, and use this glide path in the journey to manage your asset allocation and your holding period very well. And then for the glide path down, you use SWP to create liquidity. So that's actually using all the features, and then using the style lens, and using the holding period lens, and using the age or the glide path lens to actually construct your portfolio. So I think that makes it very, very tighter, for somebody. And then, if along with this, if you can have stock of the previous calculator which we spoke about, you can use that for retirement, or you can use that for any other goal. That helps you tighten the plan really, really further. So that's.
This is great. I was just thinking it's so good to have. It's kind of like a strategic three-layered this thing. We're getting to hear from the advisors and on-ground execution, as well as from a top-level planning perspective. So great insights, guys. Thank you so much for sharing. Trupti, since we are now talking about products and the different kind of product strategies that can be used, can you share a little bit about how you think the product mix has changed, when it comes to recommendations for people who are doing retirement planning, or retirees and pensioners, people in the consumption phase? Also, how do you view this change? Is there anything about this that worries you?
So basically, the biggest shift has been the penetration and awareness of mutual fund as an investment avenue, for sure. Because initially there used to be just, concentration on the small savings schemes, fixed deposits, and the real estates, which used to form the major part of the portfolios in majority, especially of the high net worth individuals, or the ones who are, had enough corpus with them. These used to be the base products which used to be there. And we are seeing a lot of change in the last 1 decade on awareness and penetration of mutual funds in this category. In the current scenario, looking at the fact that the rates are coming down, pension products surely are attracting a lot of attention, where we are seeing XIRRs of 7 to 8%. During the accumulation stage, we are seeing a lot of these pension products, and a lot of focus on EPF, PPF, where you are getting, those 7.15% RBI bonds. You have senior citizen schemes. All these are surely a focus during the accumulation stage. We had seen some time back, tax-free bonds also used to be a major focus. We had strategies like put it into tax-free bonds, and whatever interest, if you're not utilizing it, do an SIP into equity funds. This was the kind of strategies which were being used during the accumulation stage. And there are various ways. See, scenarios keep changing, policies keep changing. It is difficult for investors to stick to certain typical way of investing. So they also are evolving over a period of time. Challenges, yes, there is going to be challenges as we are seeing that the rates are coming down, and the same FDs which used to give something like 9% is giving you nothing beyond 4.5%, 5% now. And you have senior citizen scheme itself, which used to give 11%, is giving 7.4% now. There are challenges, and I think it is being very well handled by mutual funds in terms of all these hybrid funds and equity funds. One necessarily need to take exposure to these.
Okay. So, sort of coming to you, talking about the product mix, as Trupti mentioned, a lot of them are necessary shifts. I'd like to get your views on, some of the more aggressive products that we're hearing about entering the shifts, like market-linked debentures or ReITs and InvITs, also being recommended to, pensioners. What are your views on that?
So I think these are products as they are being announced, and there's always a buzz when a new product is being announced and it's being offered in the market. Same like what happens with IPOs and all. So a lot of people are actually showing interest, but I think it's a pretty complex product because like equities and mutual funds, it has a daily NAV or a daily price which is being published, and investors are actually subjected to experience the whole volatility. Like for example, for this session I was just checking. In recent InvITs, there has been a volatility of as high as 20-30%, where they went down, and then in the month of March, because there was no liquidity last year, and now they've come up. So I'm not sure if, and again, there's a whole lot of complexity in terms of taxation, because these InvITs would either give money in form of debt, or they will form an SPV and they would invest as an equity investor in those SPVs, which will eventually finance these infrastructure projects. And so there's taxation on interest, there's taxation on dividend, there's taxation on capital gain, all in the same product. And then you're also subjected to market volatility. So I think we have long way to go as long as we start explaining. And again, there is this innate need of capital preservation which is not being met. So I think these are very innovative products, but they are just being now being offered, and it really has to see the light of the market, where a lot of acceptance is being grown. To offer it directly to someone who's just retired and give it as a replacement to a pure debt product, I think would not be, it would be too aggressive to do that.
Yeah, right. So, it's like I recently read an article that was offering advice to people who are trying to do retirement planning. And it said that don't let anyone force you into investing in a product that you don't understand. So, like you said, it's more about the complexity that people may not be aware of. Okay. Shelley, coming to you, I'd like to hear your views on the National Pension Scheme, the NPS, which is supposed to be our response to the Social Security scheme. So, one is what are you seeing in terms of adoption? And second is how efficient do you think is the product in, either in the accumulation phase or the consumption phase?
So NPS, from that perspective, it has been positioned now from a defined, defined benefit to a defined, contribution. So earlier you would know your pension amount, but right now with the introduction of, NPS, it has actually been made mandatory to at least the government employees, and the contribution is defined now. So that's a very, very important thing. And across, whether it is, through EPFO or through this, the percentage of equities, at least the options are given where the equity allocation could be as high as 75%. Otherwise, traditional products, whether they have very, very low exposure to equities. So such lock-in long-term products like NPS with an optionality to have as high as 75% into equities and a very low cost of 6 to 10 basis points depending on the manager and the size of AUM they manage, and you have a variety of managers also to choose from. Some 7-8 managers are there, and I'm aware this year 2 or 3 have got added. With this kind of spread, canvas which is there, with higher equity allocation, low expense, mandatory lock-in, so that you have, and the contribution is defined. So you have to invest, at the salary the credit level, for example. That gives a very, very good, it makes a very, very good combination for an investor to have some amounts, and you have tax benefits as well. You have 1.5 lakh per annum under Section 80C, and you have an additional 50,000 under Section 80CCT. So, all this makes NPS a good proposition. But yeah, you should approach your retirement, because you can't put all your money logged in, for a period of till age 60. And there also 40%, money will need to stay there to be on annuity basis, which will be taxed going ahead. But 60% is free. So many of the things are in favor of NPS and good. These limits should be utilized. However, you should also allocate monies to equity mutual funds, depending on the comfort level. You could do a PMS, equity PMS as well, for long-term equity investing. Equity as an asset class should be chosen. The platform could be anything. It could be a passive fund. It could be a Nifty 50 ETF, or a Nifty 50 index fund, or a large cap fund, or a multi cap fund, or it could be a PMS, a combination of 2-3 PMSs and mutual funds, or it could be a very, very HNI client could do a AIF, along only AIF as well. So it depends. But NPS could be one product in the wheel of retirement, and then it could be supported by other. It should be then also having other equity oriented retirement products as well. PPF is of course good. That's another, and PPF is an important thing. But the only thing is PPF, it's again logged in for 15 years. Maximum investment limit is only 1.5 lakhs. Otherwise, the post-tax return is very, very impressive. So you can't have more than. So clients who have more than 1.5 lakhs to invest, where do you go? So of course you go towards NPS and other products. So it's a very good investment.
Great, great. Thanks for those insights. So, like you said, it's the flexibility aspect that tends to get left out in the consumption phase, and that is why perhaps other products are also required in the mix. Okay. Okay, everyone, that brings me to the last question of our panel discussion. You guys have really shared some really, really good insights. And the last question, I think, is something our viewers would like to hear from you all as well. I'd like to now ask how you all have gone about your own retirement planning, and also whether have you done it yourself, or have you hired a retirement planner to do it? After all, we are entering the age of specialization and advisory as well. Shelly, can I start with you?
So interesting question, Deepali, and good to share our little story. So for us, what has been important is, we have a home loan, so liability is there. We were clear when we took on that liability, that we'll be paying the interest, yes, but we'll be mindful of what liability we are taking up, and we'll wind up timely. Uh, but timeliness of that thing, that enjoyment, is very, very important. And there was an OD account also attached, which gave us a lot of flexibility to use the money, for the house. Of course, it was a part of the home loan, the larger part, but it also, OD is looked at from a very, very bad lens. But if you are very, very mindful, you can use that very well. Having said that, very importantly, one thing which we have done is we wound up our liability very timely. I will have to declare my age here. So I'm 40, and both me and my husband are 40 years of age, and we wound up. We're almost done with the liability. So that's one important part. Our step towards retirement. We have been aggressive, mindfully again. We all our monies are into equities right now. But yes, we have a glide path, which I also spoke about. We have a glide path in mind. Right now, we've been aggressive, but maybe the graph might at some point in time go down quite in favor of fixed income, maybe in the next few years, maybe 5, or as we approach 50 maybe. And the other part is, my husband took entrepreneurship 5 years ago, but like in a portfolio, you maintain a mix of steady earnings and a surprise earnings. we've done that. Of course, I'm working, and my husband, we are really hopeful, and fingers crossed, he'll be definitely having a surprise earnings as is ventured as well. So we were very mindful of that. I did not join him even after my maternity leave. So
Mm.
that was a conscious call we took, for our daughter. So that's how we've managed. And what I plan to do next is, we are not these Excel sheet people in terms of the micro things, but
Sure.
we might start doing that. All we do is by elimination. We don't want to do any excess
Mm.
expenses. So that's the little thing.
Thank you so much for sharing. That was, I mean, so many things that I could relate to, right? The way you mentioned using the OD. This is something that my elder brother does as well. You're probably the second person I've heard of using that. That's
Being
great.
positive,
Thank
right?
you.
Yeah.
Yeah. Saurabh, what about you?
So, I mean, for me, fortunately, I don't have to hire an advisor because I have a partner, and he has a great bouncing ball for what should be done and what should not be done. So primarily for my retirement planning, all my monies are in equities, barring one real estate. We have our own office that we bought about 6 years back in Andheri. Now we've kind of shifted to BKC. So that's the only real estate that we have, and it's debt free, fortunately. But apart from that, all my money is in equity. Around 40% is in BAF like product. It's our own strategy where we shift money between equity and debt depending on market valuations.
Mhm.
So 40% of my money is in that, and balance is in pure equities. So I'm firm believer of equities, all in form of either mutual fund or PMS. I don't do direct equities. So, but all of my assets are in equities and asset class, and it doesn't necessarily mean that I am biased and I don't want other asset classes, but
Mm.
because I'm able to digest the volatility and I'm okay with the ups and downs, I feel I should be, take the fruits of experiencing that volatility and continue to hold maximum volatility in my portfolio, equity in my portfolio.
Great, great. Thanks for sharing that, Saurabh. What about you, Trupti?
The question is akin to saying that should a doctor do a self-medication when he is unwell, or consult his peer, or probably a specialist. Frankly, I design my own financial planning model and I try it on myself first. So I have always followed my own financial planning model before I applied it to the clients. Yes, at the end of this thing, whenever there is the financial planning outcome, I always discuss it with my mentors and take inputs from them, and apply those inputs into my outcomes and try and get a better, and see that the financial process, planning process, is in line with how it has to go. I have been a pure equity person from day one, so my savings have always been in the initial 15 years of my life only into 100% equity, which I moved, and now it is into something like a multi-cap where you have 25% of pure debt and 25% of pure equity, 25% of bonds. I have a mix of this thing into 4 kinds of assets. So I am 51 now. So I am actually planning. The beauty of our profession is I don't think we are looking forward to any retirement age. But surely I would want to plan my retirement at the age of 65.
Right, right, right. Thank you so much for sharing that, Trupti. We do have one question for you and Saurabh. So, Sachiv wants to know if either of you can share an actual real life experience with managing a retirement corpus during the consumption phase.
Yeah, so I mean that's what I've been speaking out of my experience, that one of the biggest need that people have is that they don't want to see the corpus being depleting. I mean, even the whole idea of that ultimately at the end of the tenure the corpus is going to be zero, that idea itself kind of baffles them, and they just want whatever is the appreciation, I should just live on that throughout my life. And also at times, even when the numbers are completely calculated or mathematically on Excel, it becomes kind of difficult for people to digest the impact of inflation, right? So recently we're doing this for a client, and what we found out that at age 80, his expenses per annum would be 2 crore rupees, right? And he said that this is impossible. And I said that I'm not doing anything. It's just the assumption that we have discussed in terms of inflation and your current expenses. And this is just how it will grow up. So, it's very difficult for someone to fathom that, oh, my expense is going to be 20 lakh, 25 lakh rupees per month. And, the retirement corpus initially, like we just calculated about 3 crore, 4 crore kind of figures. So initially when the customer faces this, he's not very comfortable with the idea. But yeah, as we educate them more and show more and more evidence, and because there's full amount of, this is just calculation, right? This is not about any product. This is not about anything else. We're not even talking about products, but the whole need that why it is so important that you should have some kind of money coming to you every month with the flexibility of the corpus to be used for any unforeseen event, and ultimately be comfortable with that, that you will end up eating all the corpus that you would have accumulated by the time of mortality. So in real life, the assets are all over the place. People have invested in equities, people have invested in fixed income, but yeah, they are now getting the importance of investing in financial assets and are more open to kind of move their money towards financial assets as opposed to keeping it in real assets.
Great. Thanks for sharing that, Saurabh. Trupti, do you have anything to add on to that?
Actually, I have seen two extreme cases when it comes to consumption phase. Is that the ones who have limited amount generally tend to splurge more, and tendency is that we need to keep pointing to them that this is not the time to splurge, because what standard of living you have had during the accumulation phase, you can't have that during the consumption phase. We have had, as Saurabh had pointed out before, we have not gone through the accumulation and the consumption phase all by ourselves. Somebody has done the accumulation phase planning, and we have done the consumption part. And certain places we have done the accumulation, but we have not yet come towards the consumption phase. So there, in one other extreme, there is huge corpus, but they restrict their expenses purely because they are not getting enough returns. That has been the experience when it comes to different kinds of clients.
That's a lot of insight there. It ultimately so much boils down to the investor's psychology, right? And being able to explain things to them. Great. So if we don't have any further questions, I'd just like to take this opportunity to thank all of you for joining us and being so generous with your time and insights. I hope the viewers have taken as much insight and value from this as you have offered. Thank you so much. And a big thank you to our viewers as well for joining us and staying with us. We look forward to seeing you whenever we bring the next edition of iFAST Advisor Insight. A very good evening to all of you. Take care. Bye-bye.
Thank you.
Thank you.